Welcome friends. Today we are going to just revise the previous chapter in which we had learned of various formulas for finding GDP at FC, GDP at MP, NNP, NDP, etc. Today a basic formulas of market price equal to factor cost plus need. It can also be find out like this: factor cost plus indirect taxes minus subsidies. Now factor cost equal to market price minus net indirect taxes. GDP at FC equal to GDP MP minus NEET. GDP MP equal to GDP FC plus NEET. National income equal to domestic income plus net factor income from abroad. That is, whenever we are going to find NNP at FC, it's always NDP FC plus NIFA. Domestic income, that is NDP FC, equal to national income, that is NNP FC minus NIFA. For example, GNP equal to GDP plus NIFA. Today we are going to start with a third chapter, measurement of national income. Regarding the previous chapter only, we can find national income by various methods, but today first we'll go for the definition of national income. National income is the total money value of goods and services produced by a country in a particular period of time. The duration of this period is usually of 1 year. You should remember it should be produced by a country for a period of 1 year. We can also define a national income by the three viewpoints. As we had suggested in chapter 1, there are the three phases. The three viewpoints are also created. Production phase, so it's a production viewpoint. Income phase, so it is an income viewpoint. And disposition phase, that is a expenditure viewpoint. In other words, a method of measuring a national income can be of three ways: value added method, income method, and expenditure method. Value added method includes net value added by all the producing units. Now, which are all the producing units? Primary sector, secondary sector, and tertiary sector. You have to add all three sectors. You will get GDP at MP. Income method, the sum of all factor incomes. Now you all know what are the factor incomes: rent, wages, interest, and profit. These are all the factor income. When you add all the factor income, you get a income method. Expenditure method, that is sum of all the items of final expenditure. Here please remember, the final expenditure is only included. In this video we will be talking only about value added method or product method. Value added method includes all the final goods and services produced by public and private enterprise in the domestic territory of the country in an accounting period of 1 year are measured at their money value. In other words, you have to add all the three sectors which are produced within your country in particular 1 year. Here, how to measure a national income and its aggregate using product method or value added method. The first thing you have to do is add primary sector, secondary sector, and tertiary sector. Then you have to find value of output, that is price into quantity. Multiply price by quantity, or value of output equal to sales plus change in stock. Please remember, closing stock minus opening stock equal to change in stock. Then you have to find the intermediate consumption. Now what is the intermediate consumption? That is the expenditure done to produce the final goods. For example, a flour is an intermediate goods for bread. However, here remember, machinery purchased is not an intermediate goods because it is used for various other purpose also. So it is not an intermediate goods. Imports are not separately included in intermediate consumption if intermediate consumption value is given. However, if domestic purchase is specifically mentioned, then imports are to be added in it. After estimating the total value of output in an economy, we calculate GDP at market price. How you find it? A value added at market price is equal to value of output, that is price into quantity, or sales minus change in stock. From this you have to minus intermediate consumption. Remember this formula because you usually get confused with this formula. After gross domestic product at market price, it is the same as the second chapter, that is NDP-FC equal to GDP-MP. Now MP is changed into FC by minusing NEET. G is converted into N by minusing depreciation. Then we move to the final stage, that is NNP-FC, which is equal to NDP-FC plus NIFA. Now, certain precaution of value added method. This is asked in 3 marks question. Remember the answer. Intermediate goods are not included in national income because there is a problem of double coincidence. So we include only the final goods. Sale and purchase of second-hand goods are not included. However, commission and brokerage is always included. Production of services of self-consumption are not included. But domestic services of housewife, kitchen, garden and all this are not included in national income. But remember here, paid services like services of maids, driver, private tutors, etc. should be included in national income. Production of goods for the self-consumption will be included in national income as they contribute to the current output. Remember here, the value is to be estimated or imputed as they are not sold in market. Imputed value of owner's occupied house is also included because owner has not to pay the rent. Change in stock and inventory will be included in a net increase. As there is net increase in the inventories, so it is included in the capital formation. Finally, we go for the chart. Value added, that is P into Q, or you can go for sales plus change in stock. You will get a value of output. From value of output, you will deduct IC, that is intermediate consumption. You will get a value added by the sectors or firms plus value added by other sectors or firm. You will get a gross domestic product at market price or gross value added at market price. You will deduct depreciation. You will get NDP at market price. You will add NIFA. Then you get it NNP at market price. You deduct NEET. You will get NNP at FC. This is your national income. Thank you students for listening to this video. We will very soon come with part 2, which will include income method. Thank you.